Good afternoon again from Ho Chi Minh City, and welcome to the latest Dragon Capital webinar, the subject of which today is property. I'm Bill Stoops, the CIO of Dragon, and I'll be your moderator. This webinar follows on from our previous one about infrastructure. Infrastructure is establishing itself as the big economic driver in Vietnam, and property, of course, is very tightly linked with it. The agenda for today is that our Deputy CIO, Dr. Tuan Lay Ang, will kick off with a backgrounder on the macro market situation and an update on COVID-19 as we make our way through a recent wave, similar to neighboring countries, but with far fewer cases. Then our Associate Director of Research, Mr. Ming Ching, will present on the core subject, which is the emergence of new cities within the big conurbations of Saigon and Hanoi. And after that, we'll have an open conversation between our Senior Real Estate Analyst, Mr. Ta Huang, and the Head of Transactions at Jones Lang LaSalle, Vietnam, Ms. Chan Bui. And finally, at the end of everyone's comments, we'll open the floor to Q&A. Now I'd like to ask Dr. T to start us off with his look at the economy, the exchanges, and the pandemic.
Thank you, Bill. Allow me to share my screen. Good morning, good afternoon, and good evening. My presentation today consists of three parts. Part one will be about COVID, and then part number two is I will talk about how COVID may impact the Vietnam economy. And part three, I will discuss about the equity market. Part one, in terms of COVID, prior to May 2021, Vietnam has been successfully contained and recovered from COVID. Between those three major waves, we have about 1,500 cases, 35 people dead, and basically 3 weeks of national lockdown. And however, in May 2021, we have the Indian variant, the COVID Indian variant, and that is probably the most dangerous so far. So far, in the last 1 month and a half, we have 7,500 new cases. We apply social distancing for 3 cities, including Ho Chi Minh City. Hotspot, the key concern is the hotspot is in the multiple industrial parks in Vietnam. 24 deaths so far, and we expect this wave will take longer time to control, and expected in July. The big difference this time is prior to May 2021, we have only 250,000 doses of vaccinated people. And now we have already ramped up to 1.4 million doses. So right now, because of COVID, this time, in the top of the mind from the government is vaccination. So far, we received only about 3 to 5 million doses until June. But we have been secured 155 million doses, and that expected to deliver in late Q3 and Q4. So given that easily cover 77% of the population in Vietnam. The more encouraging outlook for Vietnam is the local company has been developing their own vaccine already, and mostly in late phase 2 and early phase 3. And I'm expecting the approval will happen in Q4 this year, and the capacity is about 20 to 30 million doses. There's another 2 companies in Vietnam also received technology transfer, one from Russia and one from the US. And the capacity can run up from 100 to 200 million doses. So given Vietnam as a developing country, I think having our own vaccine is, I would say, it's a good thing, to think ahead of it, to ready for whatever next virus coming. So that, for me, is a good international security. The conclusion for the COVID is this wave of COVID is widespread in multiple cities, so it will take longer to control. It has a negative impact on production as outbreak happens in the industrial park, but less on consumption because we are used it already. And by the end of 2021 or early 2022, we believe 40 to 50% of the population will be vaccinated. Okay, so given what happened in COVID, so how does the Vietnam macro outlook look like? You have heard from me a lot of optimism, my optimism in the last a few webinars. I'm not going to go that shallow. This time I take you to a bit deeper level. I try to compare Vietnam right now compared to the past and how the outlook look like. So I will not talk like like the GDP number or the FDI or the export growth, but rather I give you a heat map for Vietnam economy. And that my heat map I decompose into 3 different parts of the heat map. Number one is economic growth, in which you can look at the GDP number. If you look at the green color, it's good, the red is bad, and the yellow basically is neutral. GDP in the first 5 months, I would say is quite good, but because of the COVID happened in industrial park, the outlook for the second half most likely to be neutral compared to the current status. On the consumer sentiment, because of the Lunar New Year happened, we also have COVID, so the consumer sentiment, I would say to be quite neutral compared to current consumer sentiment. However, because of the global disruption in global supply chain and the COVID happened in industrial park, the PMI likely to be negative. So in terms of growth, at the moment, the outlook for the next 6 months is less rosy compared to the first 5 months, but it's much better than overall, much better than 2020. The second part of my presentation on macro heat map could be domestic stability. On domestic stability, this is a key part of my presentation on macro, because without stability, there's no good return on stock market. First, you look at CPI, the inflation. Inflation in the last few months in Vietnam, people have been worried about inflation. And given I'm going to go deep into inflation in the next few slides, but the inflation in the next few months is promising, meaning is under control. On the deposit rate, on the lending rates, thing has been neutralized already. It cannot go lower and it cannot go higher. So basically quite neutral. On the bond yield at the low level already, I don't think it can go up or go down much. So basically on the bond yield environment, I think neutral. On the credit growth, the good side is I see companies start to borrow money. I see people start to borrow money. That is optimism. That's why on the credit growth, it ranked, the outlook is good. So on the domestic stability as a whole, the domestic score actually better than the first half of the year. On the domestic, on the external position, you look at the trade balance. Trade balance in Vietnam has been excellent in the last 18 months, excellent. However, because of the disruption in global supply chain and in the industrial park, the trade balance, I would say it could be neutral in the next 6 months. On the FDI, Vietnam have too much of FDI. So even though FDI might slow down a bit, but that's still very promising. On the FII, foreign indirect investment, it has been negative so much. There should be like $3 billion outflow in the last 12 months. So recently, in the last few weeks, the foreign outflow has been neutral. That's why the outlook could be neutral to positive. On the currency, it has been appreciated against the dollar, and I think the trend will continue. On the CITES, how the world look at Vietnam in terms of sovereign rating, Vietnam has been improved significantly. So in terms of current rating, it's good. The total external score is actually as good as the last 5 months. So in terms of growth, it deteriorated. In terms of domestic stability, it's improving. In terms of external position, it's remained quite good. So that's the total picture of Vietnam economy. So let me go into inflation for go to inflation. If inflation, I get it wrong, the whole picture could be completely different. Inflation in 2020, the cost of inflation in Vietnam, the total inflation is 3.2%. But if you look at inflation, that 100% can be explained by food and beverage. And food and beverage in Vietnam mostly explained because of pork price has increased so much in 2020. Or the sector is almost not even going up. That explains why CPI, the core CPI, is only 1%. And then you look at the cost of inflation in the first 5 months of 2021. 2.9% inflation year over year, Basically, 80% of that inflation can be explained by transportation. And transportation is what? Oil price. Oil price has been rallied so much in the last 5 months compared to last year. And all the sector, including food and beverage, doesn't really move up at all. That's why the core inflation is only 1%, similar to last year. So that explains why I'm not too concerned about inflation. But let me go a bit deeper in terms of pork prices. So why I talk about pork, one slide in my whole presentation, because if you are an economist in Vietnam or in China and you don't follow pork, you make a big mistake. The pork is a key driver for inflation in those countries. In China, they rebuild faster than expectation on cow side pigs. Cow side pig is the cow, the pigs as big as a cow, okay? And Vietnam already rehearsed the pig like to pre-African swine flu level already, meaning we already have the herd, the number of pork increased significantly. We also have the policy to import pork in Vietnam right now, drastically compared to a few years ago. That's why you look at the pork price in China has been dropping like 50%, but the pork price in Vietnam dropping only 20-25% only. So there is actually, we strongly believe the pork price will not going up, but rather going down. That helped a lot in inflation. That is why I'm confident inflation in Vietnam can be contained. Let me recap in terms of the macro outlook. First, in terms of growth, we revised down from 7% to 6% growth in 2021. In terms of export, we have 22% growth compared to 7% last year. In terms of import, we have about 25% growth in import because of a domestic recovery. And the trade surplus still about $15 billion, given about $20 billion currently. Inflation 3.5%, currency reserve from increase about $10 to $15 billion, and the currency we expect to appreciate 1% against the dollar. So far, it has appreciated around 0.3 to 0.5% already. Okay, so given the good outlook for the macro, how is the equity market, behaving? First, surprisingly, the foreign outflow in the last 3.5 years, has been outflow for $4.3 billion. This is the biggest outflow in the history of Vietnam equity market. Despite of that, the equity market have doing quite well. So that raised a concern. Whether the local buy-in to the outflow of foreigner, can it be sustained? Is it sustainable? Is it a bubble? Is it retail? That's why it's not sustainable and it's volatile or not. So I'm going to answer that question. First, the new account opening has been rally like a rocket. People may argue, yeah, it's COVID time, so people stay home, don't have anything to do, so they just want to gamble. Maybe true, I don't know, but it happened to be the eKYC in Vietnam happened late 2020. Before, if you want to open the stock account, you have to travel to Hanoi or Ho Chi Minh City for stock account opening. But now with the eKYC, completely you can stay home in the remote area and take 3 minutes to open a stock account. And that explains exactly why the number of accounts has been rallying rapidly. But even of this rally, it only accounts for 3% of total population only. An example you look at Taiwan, for example, in the 80s. When Taiwan in the 80s, when the GDP per capita is about $5,000, that's exactly where Vietnam is right now. Then Taiwan enter a massive retail growth account. Vietnam exactly this reflection point, okay? Okay, so the consequence of the retail opening account, what is, you look at one phenomenon, the cash availability to buy into the market from the security companies about a year and a half ago, in the end of 2019, is only $700 million. But now, given the retail participated in the market, $2.4 billion availability in the security accounts to buy into the market. Of that $2.4 billion, 1/4 of it is coming from the top 2 retail brokers. That show retail is not only leverage, but also they put real cash into the market. About the margin overlend, the margin lending, it has been a concern in Vietnam because it rally a lot. But if you take a margin lending as percentage of the floated market cap in Vietnam, it is only 4.1%. If you compare to Q4 in 2015 and Q1 2016, the margin lending also at a high level. But that is show the optimism, and that exactly 2017 is the best year ever in Vietnam equity market. So if you look at the margin lending as annualized liquidity, it actually slowing down. So that, you know, margin lending is up, but not alarming level given the current liquidity level. So let me look at the valuation. Given the current rally, the price earning ratio is only 12.8 times only for 2021 and only 10 times for 2020. Given the earning roll up about 52%. 52% for 2021 and 22% for 2020. The debt equity ratio is only 20%. And the yield is low. The low yield because the banking sector doesn't pay cash dividend because of the central bank doesn't allow it this year. But if you look at what? You look at, so whether the 55% earning growth is real, is it high number, is it sustainable? One look at this one. Q1 number in 2021 already delivered 70% growth because it's coming from low base in 2020. We expect the Q2 could be about 65% growth, and it could be decelerated to about 25.6% in Q4. Basically, Q4 last year, earning growth has been quite normal, about 15%. So this year, 26% growth is already good number. That is a good transition to 2022, in which we expect 22% growth in 2020. So overall, the equity market, there's a part of margin lending, which is high, but that's not the alarming level. In the valuation, there's a strong role to back it up, the valuation, and you cannot say it's expensive if it trade around 12 to 13 times price earning, given 50% growth this year and 22% growth next year. Thank you very much, and I end my presentation. Over back to you, Bill.
At this point, I'd like to introduce Ming Ching to talk about the core subject I mentioned earlier, this phenomenon of new emerging cities, big satellite cities within the already large conurbations of Saigon and Hanoi. Over to Ming Ching.
Hi everyone, let me share my screen. Okay, so I'm the property analyst at Dragon Capital, and in this presentation, I would like to take a deeper look at what the impact of Vietnam's infrastructure investment on the property market. Let's start with what we ended last time. As we all know, Vietnam is going through the transition from the bike economy 30 years ago to the motorcycle 15 years ago, and now is the era of cars. As a result, the travel time has been reduced greatly throughout the time period. This is a map of Ho Chi Minh City inner district. In the 2000s, it could easily take almost 60 minutes to travel from the outer district to the city center because of the lack of infrastructure. With the economy and infrastructure development, the prosperity of Ho Chi Minh City residents has increased. More cars appear on road, and with bigger roads, more bridges, the 60-minute travel radius has been expanded to a second-tier province. We are witnessing the development of new urban areas in Dong Nai, Long An, and Cu Chi. Yet the current infrastructure is not keeping pace with economic boom and growing population. If we look at the developed country standard, 40 kilometers in 60 minutes is still not acceptable. So we believe with the upcoming infrastructure boom, the 60-minute travel radius will be expanded even further to around 50 to 80 kilometers away. This will be the premise for the emergence of Ho Chi Minh Metropolis. Let's zoom in the largest circle. The future of Ho Chi Minh City metropolis will be a host of satellite cities surrounding the city core. We have all heard about the new formation of Thủ Đức new city, the so-called Pudong of Vietnam, but this is just a start. In the upcoming infrastructure investment phase, Ho Chi Minh will have at least 3 more new urban areas, Củ Chi, Nhân Trạch, and Cần Giờ. Together, these satellite cities will be closely connected by a network of ring roads, as shown in this table, and of course, the metro line system. Similarly, we will witness the emergence of Hanoi capital region. This is the old quarter in Hanoi. In the past 5 years, the city has been expanded steadily in all directions. You have seen the development of new urban areas such as Long Biên in the east of Red River and Hà Đông in the south. There is more to come. Hanoi 2030 vision will follow the urban cluster model, 1 central city and 5 satellite cities, with travel time continued to reduce greatly thanks to even bigger infrastructure project as listed in this table. So what is the implication for property market? As the old saying, the shorter the travel distance, the higher the property price. But this is just one positive outcome of infrastructure investment. Better connectivity will lead to rapid urbanization and increased population density. It is the foundation of economic growth, which will drive people's wealth, result in higher property demand. The bottom line is, this will open a huge new market demand for property developers. Now, so far, we have talked about the vision of Vietnam emergent metropolis, but how to quantify and forecast this mega trend? We think the most appropriate way is look at our neighbor, China. China and Vietnam shares many similarities: state control, single communist party, FDI, middle class formation. This is the chart of GDP per capita. As of 2020, Vietnam's GDP per capita is about 3,500. This is of China 12 years ago. In terms of property market, China property market has enjoyed a 15 years miracle growth from 2003 to 2018. How many times people have worried about the imminent burst of the property bubble? Yet, China property market has grown a very sustainable rate of almost 10% in both price and volume during this period. So what makes China property market so successful? Besides the strong economic growth, list out a few important criteria in this table. The China 2003-2018 has all the box ticked, from the strong government, credit availability, to income growth, and of course, resident high appetite for property investment, all in good to excellent score. Now let's put Vietnam side by side with China. We think Vietnam is following the China footstep, but with slightly lower score. Our criteria for Vietnam is medium and improving, but our weakest point so far has been infrastructure investment. So why infrastructure investment is so important? From 2003 to 2018, China public investment grew at almost 20% year-on-year CAGR, massive investment growth. This has led to a great urbanization trend from 40% in 2003 to almost 60% in 2018. Together, infrastructure and urbanization drive economic prosperity. GDP per capita has grown almost 15% annually. Vietnam's current urbanization is very similar to China in 2003, and our GDP per capita is even actually higher. So we believe that with the government promise to focus on infrastructure investment in the next 10 years, we have sufficient condition to believe that Vietnam urbanization trend and GDP per capita should grow in similar trend as China. By 2030, urbanization in Vietnam should reach 60%, and now GDP per capita could reach 9 to 10,000. So the Great China public investment cycle has made a massive impact on its property market. Property transaction and property price supported by the economic growth have both increased close to 10% annually. We believe the same trend will happen to Vietnam property market, especially with the emergence of metropolis. Property transaction volume and property price should increase at a healthy rate of 11% and 7% respectively. What about affordability? This is the area where everyone has concerns. China's great property cycle has led to lesser affordability. The house price to income ratio, measured as number of years for people to buy a house, has increased almost 2 times from 2003 to 2020. In the economic driver cities such as Beijing and Shanghai, it is even harder for people to own a house. Here's the situation in Vietnam. Our property valuation is already not cheap. Recently in the media, you may have heard about the ultra luxury offering in District 1 with 15,000 USD per square meter. And you may wonder, has the market getting too hot? Let me reassure you that despite some pocket of heated pricing in the ultra luxury segment, this price tag does not represent the entire property market situation in Vietnam. Despite that, our housing price to income ratio is already about 20 times in Hanoi and almost 25 times in Ho Chi Minh City, not far from leading cities in the region. Our gross rental yield is slightly better though, at about 4 to 4.5%, indicate that the current supply is still healthy. Now, with the upcoming infrastructure upcycle and the expectation in metropolis, we think our price to income ratio will continue to increase and approaching the regional top cities. Here's the message that I would like you to take away. Don't expect Vietnam property price to get more affordable, and don't expect everyone could buy a house. However, as we learn from China lesson, don't expect it to burst either, because as long as the 3 macro driver, infrastructure, urbanization, and middle class formation continue to be strong, this will be an expected and fair trend. So what is the implication for the listed property companies? Let's go back to the map of future of Ho Chi Minh Metropolis. As you can see, the leading property players have visioned this future and snatch up attractive land bank in the suburban area, awaiting for the infrastructure coming. Not just that, the size of land bank has increased almost 10 times. No longer 10 to 20 hectares. We are thinking about 400, 500 hectares, and soon it will be 3,500 hectares. The bottom line is, our leading developers might see their earning increase 3 to 5-fold in the next 10 years. So far, we have focused about the traditional stuff. Bridge, road, land bank. You may wonder, what about something new? So let me touch on the latest development of property industry trend, the digital infrastructure transformation. 20 years ago, buying, investing in property are done 100% offline. The whole transaction is tedious and lengthy. With the internet, property investors now have online channel to do their research. In Vietnam, the #1 channel for property research is, interestingly, Facebook. As a result, 30% of transaction process can now be done online. Yet you still need to meet the counterparty, do the paperwork offline. Now, however, you look at the global trend, property transactions are now migrating to online. The future market will be an all-in-one platform where buyers and sellers can meet and match online and proceed with the transaction 100% online and secure. We think Vietnam property market is ready for this next wave of digital transformation. The reason we have confidence in this trend is because we believe the Vietnam market has reached an inflection point. As of 2020, our property market size is almost 60 billion. The 6 billion from leasing, 9 billion from primary, and a whopping 46 billion from resale. Total participant is approximately 1.5 million, which 500,000 brokers, and more than 1 million professional property investors. This creates an extraordinary opportunity for property developers to spring ahead with digital innovation. Look at this map of Vietnam PropTech startup. More than 150 startups are competing in different aspects of property transaction, from listing, searching, tech-enabled brokerage to real estate fintech. The bottom line is the race is actually wide open for everyone to participate. The traditional property developers have all realized this trend and have started invest heavily in this space. You have Bing Group with One Housing, you have Sandland with Sand Homes, and Hung Tech with Toppen Land. They have to compete with local fintech and as well as big international players. If you are late into this game, you will soon pay the price in the next few years. Let's conclude our presentation. The emergence of Metropolis in Vietnam is happening, and thanks to the infrastructure development. As a result, the addressable market for property developers expands several times, and so as their earnings. Vietnam property market is very similar to China 2003-2018, and we are just at the starting line of a great upcycle. The negative consequence is our affordability will probably decrease, and it is an expected trend. Finally, we are witnessing the early sign of digital innovation, and the race is wide open for everyone to participate. We will very soon see the emergence of New Bay Compass in Vietnam. Thank you very much for your attention. Back to you, Bill.
Thanks, Ming. And now it's time for the open dialogue between our very own Ta Huang, the Dragon analyst on real estate, and Ms. Chang Bui from Jones Lang LaSalle, Vietnam. And I'm going to open the floor straight over to them. Thank you both.
Thank you. Hi, everyone. I'm Todd, a property analyst at Dragon Capital. And with me today is Ms. Chang Bui from JLL, an industry expert on property in Vietnam. After Ming's presentation, I believe that you all have a good overview about Vietnam property market outlook, but there must be some concerns and questions. So we will have an open discussion today to discuss 4 key topics. And hopefully after this session, you will have a much better overview on Vietnam property market. So chị Chang, thank you for joining us today. The first topic is about property developers. As you know, JLL has been working a lot with both local and foreign developers. So can you share with us how are they positioning themselves for the upcoming infrastructure cycle?
Okay, hello everyone, and first of all, thank you for having me during the sessions. So back to the questions. Well, yes, we've been working with a lot of fund and also developers in the market, both foreign and also local players. And in the past 15 years of the market, and we had also seen the market gone through different cycles. So at the moment, with the infrastructure investment commitment from the government, and also development happening, infrastructure development happening everywhere in the country, particularly to the greater city of Ho Chi Minh City and Hanoi, which we have seen that I'm talking about the local developer first. We see the local developers, they actually also have the strategies accommodate and also, come up with the new trends of development. Before we have been seeing, they must more focus on residential high-rise products in the city centers or in the main cities. But now a lot of projects that we see is that developed by local developers are much bigger size. We call them mega cities or the mega projects, with the sizes range from like minimum of 10 hectares to also like 100 hectares or even 1,000 hectares. And in the location of outskirts of the cities. So that's what we have been seeing for the local developers. An example of that like Nam Long or, or Novaland or, Vindrup is a key players. For foreign developers, we see also there are two types of group foreign developers. One is has been invested in Vietnam over 10 or 20 years and have the very clear and commitment for the Vietnam real estate market. They continue to their strategy and also investing in not only in the city center, but also the outskirts as well, and also to the second tier cities. And one of the particular trend of that, we see that foreign developer which that already have the presence in Vietnam long term over the 10 years. They are quite actively acquiring the land bank to, continue for the future developments. For the foreign developers or fund that looking for or also very active enter into the market, they sort of for their strategy and the way that they position the difference, what the strength they have is the capitals and also perhaps some know-how in the developed market. But what I'm missing is also the local know-how. So what we see is that for those, foreign fund or developers, they more looking for investing in or back the strategy of the portfolio or the projects that proven the capacities and also track record. Yeah, so that's what we have been seeing. And first of that, they also, for those particular foreign developer, they would more looking for the project in the main cities rather than the second tier city.
Thank you, chị Trang. Based on Minh Trịnh presentation and what you share just now, I noticed that many projects, mega projects, will be developed by local developers. This is a concern, right? So any risk of execution in the next 2 or 5 years?
Okay, so there might be the wondering questions, or is a questionable whether local developer they have the financial capacity or execution capacity or development capacity for the mega project. I might say that they have. In the previous cycle, watch that we have witnessed a lot of large projects in both, Ho Chi Minh City and Hanoi. It has been developed not successfully, and it's still now is still like under construction for 10 years or 5 years. And from that cycle, I guess it's filter out the more quality and also qualified developers. And also the market has been evolving to the new phases, which is just more mature and then it has been evolving so much since 2015 when Vietnam real estate market got out from the financial crisis. And since then, we have been seeing the local developer getting really strong and very committed, and they also utilize very well their advantage of understanding, the local consumer base and also understanding the permitting and what happening in the country. So, and one thing we witness about the market is that those developers, they sort of have learned from that cycle what other failed developers has faced, and they sort of improve their skill set and also partner with, with the foreign fund and also foreign partner to improve their skill set. So all I can say is that I'm not saying that all the project in the country not going to face into the risk of execution, but majority of the big township we see that is handled by quite qualified developers.
So in brief, the risk of execution from local developers is low, medium,
low,
or high?
I think it's quite low.
Okay, thank you.
Yeah.
Moving on to the second topic about the China development model. China has been so successful and Vietnam is so similar to China. So it makes sense to expect that Vietnam will follow the success of China property market, right? But are there any risks that Vietnam market will not sustain itself as strong as China market?
Uh, wow, this is a very interesting question. I think that in the reverse presentation, we see, well, Reagan Capital illustrates quite well the similarities between, China real estate market and Vietnam real estate market, and also what in the reverse presentation, I think is quite interesting, where showing the role pattern of China, and of course whether Vietnam going to the same role pattern, or maybe grow bigger, or maybe some sort of lesson we can learn. So I agree, there are a lot of similarities in terms of the golden phase of growth right now, like China has enjoyed in the past 15 years, particularly to that infrastructure improvement and investment. And also, the result of that is that we see the formation of satellite cities. Like in the south, is going to be a formations of a satellite city around the core city. So that's similar. But also we see there is a big difference between both market, and I'm going to talk about that in a minute. So the key difference is in all the satellite cities in China is mega size as the core city. An example like Hangzhou, or or Shenzhen, those cities around Shanghai, the population size as a first is around minimum it's 8 million to 14 or 10 million population, where the satellite city in Vietnam are much smaller size. So speaking of that, so we see the differences is that the integration township development in those satellite city or satellite city itself won't sustain itself. But the development pattern will be a little bit different, where I think that all the development from the satellite city is still sort of the connectivity, and also the accessibility to the core city is still very key. That the first differences. And the second differences is that for the satellite city in China, if we look at that for the pattern of growth, we see all segmentation of real estate are also formation beside with the residential, where in Vietnam will be a little bit different. All the satellite city of the development will still mainly focusing on the residential township development and services. It won't be full integrated of all real estate sectors. And where for the all real estate sector is still mainly in around the main city or the core city.
So basically, the development pattern will be very similar, but they are like China will have more advantages over Vietnam because they are bigger.
They
And
much bigger, exactly.
Yeah, cities can sustain themselves, and they have with that they can have more product offerings. Is that correct?
Exactly. But for Vietnam, it had to connect back, or access back to the core city.
Yeah, thank you. Moving on to the third topic, closer to Vietnam. We all know that in the last 12 months, property price in Vietnam has accelerated a lot, especially in Ho Chi Minh City, where we are sitting right here, right? So recently, there is a luxury project being offered at like 15K per square meter. So very briefly, is the market overheating or not, and why?
Oh, yeah, good question. Again, it's not easy question to answer, but our view is that we don't think it's overheating. We think that, well, let's put it this way. Any product has its own market, and some product for the mass markets with the mass price, or medium, or high end, and some product for its niche market. And when the market have the price sort of quite stand out significantly, like the product that we're talking about here. So the way that we look at this is, in those particular cases, offer us a many perspective to look at that. Some may say it's crazy. Some may say, it's really, over the price, or many opinion. But for this case, we think that this product is designed for to accommodate its target need market, that number one, and also for the economic growth of Ho Chi Minh City. And the third is that the location of the project is that the very unique locations and also qualified to be the global access address. An example of global address access is kind of like Marina Bay Sands. If we're talking about Singapore, immediately in our head, we're gonna think Marina Bay Sands. So this is classified at that type. And that's so therefore the position of pricing will be different, and it has to be ranking with the global access pricing kind of access. It won't be sort of classified or also comparable to the city asset kind of product.
Actually, Vietnam is still a developing country, right? So 15K per square meter is a bit high to me, but back to basic, Vietnam is a developing country, so mid-range segment should be the key pillar for the market. So to know that the market is overheating or not, we should look at the mid-range, as I assume. So can you share with us the mid-range segment in Vietnam? Is it still healthy or is it slightly overheating?
It's healthy in both perspective, in both demand and supply. The demand are very strong. Well, I agree with you that that 15,000K is not even overpriced to you personally, but even to me and to many, general income. And I agree with that. So if we look at the more sort of affordable or more sort of general type of product or mid-range, I think that is so healthy. Is a Vietnam real estate market during this time is a little bit unit in a way. Unit, when we talk unit, it could be negative or could be positive, but in this case, I mean it positive because in the past 2 years, the market is undersupply for mid-range. Because some regulation in the country happened to the real estate development permitting is taking longer than before. So, and then the developer wouldn't be able to develop the product to launch to the market to accommodate to the growth, the demand. So in terms of the price roll for the mid market, it ranges from quite reasonable rate. It's from 6% to 10%. It depends on the area. It's not like crazy over sudden like 50% or 20 or like 100%. We don't see that. So it's quite healthy, and also the absorption is also healthy as well. A lot of projects are still launched in some particular is quite a little bit high price, but because of the experience also the reputation of the developer or the location. An example to team like last year also some project has launched at the 10,000 per square meters as well. So overall we see that it's quite healthy market for now, and it's still under supply for the mid-range kind of product, and then net absorption and time market is quite strong.
Thank you, Chang. Great to hear that the market is still healthy, not overheating. Moving on to the last topic. This is the first time in a property presentation that we mentioned PropTech, because previously it was almost none. So can you share with us, are there any other trends in the property market that we should be aware of at the moment?
Trend, you mean for PropTech or like digital transformations? That's what you mean?
Key major trends that we do not mention yet, very briefly.
Oh, right. Okay. So key major trend, I think that we talk a lot about residential market. The market now, which also we see residential is a sort of traditional segmentation for the real estate, but we also see a lot of non-traditional asset class. An example, data centers or infill located, cold storage, or urban located. Those kind of sectors are also forecasting to grow in the coming years. So that's the trend.
Yeah, thank you, Chang. So to recap our discussion today about developers, I think the risk of execution of local developers is low or at least not high. So we don't need to lose sleep about the execution of local developers developing mega projects, right? The second topic is about China development model. The trend will be similar, but we buyers and developers should be aware that China have a lot of advantages, especially in the size. So we should be aware of this disadvantages, select disadvantages when developers develop big projects. The third topic is price and the state of the market. In general, the market is not overheating. In mid-range segment, it's still very healthy. And that's a key pillar of the market. The fourth one, there are some other trends like PropTech, cold storage, logistics, and many others are going on, showing that the market is very strong and there are a lot of opportunities for everybody. Thank you, Chị Trang. Bill, over to you.
Thank you.
All right. Well, thanks to both Chang and to Ta for their open dialogue. Very enlightening. And now it's time for Q&A. We've got one question which is directly related to the investment opportunity property. Before I put that one to Ming, I'd just like to ask Dr. T to prepare for some questions on the relationship between developers and banks, and for Chang to watch out for a question on how closely infrastructure development is actually supporting property. Right? So the first question now is for Ming, and it reads as follows. Ming mentioned several companies in his presentation that are active in Saigon and Hanoi, and he said their earnings would be up 5 times, actually it was 3 to 5 times, over the next 10 years. Can he tell us about their valuations right now? Also, what is their debt situation like and the average debt equity ratio?
Right, so for the companies that you are in our coverage, the valuation, the PE is from around 10 to 12 times, and the debt to equity is about 0.5 times. And I just want to highlight this debt to equity ratio is actually on a decreasing trend. So if you compare it with the previous property cycle, property developers, the surviving companies, they have much better financial position, and thanks to the pre-sale, strong pre-sale and stronger cash flow, their financial position is much better as compared to previous cycle. So now, if you look at this valuation and you look at the future forecast of these guys, I think it is a classic textbook. If you look at other leading cities, even in the region, just such as Seoul in the 90s, Jakarta, for example, you will see that earning increased 3 to 5 times. So the valuation, even though at the moment I would say that it is not cheap, but because of such a strong expectation for the long-term growth, they look still very attractive, and we should go for it. Simple as that.
I think you're talking about the textbook, as you call it, phenomenon of the expansion of cities from the center, right? We see it in Jakarta, we see it in Bangkok, we saw it in Seoul, like you said, in the 1990s. When I was living in Manhattan in the 2000s, Manhattan was still expanding from the center into the meatpacking district, into the East Side Highway, further down into Alphabet Land. So this is something that happens, and Saigon and Hanoi are just following a blueprint. And I suppose if you own the leading developers, you're just going to have very successful investments by holding them, putting them on autopilot, for this 5 to 10 year period. Okay, Dr. T, as mentioned, we have some questions on the relationship between bankers and the developers. It's a series of technical questions, so let me just run you through them. First of all, what is the banking appetite for development loans as a share of their lending book?
I think the bank in Vietnam, one of the problem I see is they're always very conservative. Don't only lend money if there is collateral value. So even if it is a development loan, it is mostly focused on SOCB. Even right now, SOCB is reluctant to do so. So as long as the development loan has an ability to pay back, otherwise there's no loan for you. So the relationship between development loan as a percentage of the share of the loan book is weak. I don't think there's a strong link.
Do we know what percentage of loan books property development credits are typically?
Could be tiny, Bill. Mostly of the development I think the question I may misunderstood it. I think the question is it about development, meaning development, economic development, like the project which is like 10, 20 years with a low return on equity. Or is it development, property development? If it is a development in terms of economics, like the project for 10, 20 years with a low return on equity, that's my answer. If the developer, if there is a relationship between the developer, property developer, and the bank, the answer could be like before the developer relies heavily on the banking sector. Now actually it's not. Now they basically developer, they basically like do a wholesale, like if you come in, you can take the whole building and then they put the risk to the end user. So the bank has to deal with the end user, the buyer, not the developer itself. And developer doesn't borrow much money from the banking sector.
The next question is, what are the usual maturity terms and spreads on both development and mortgage? Any difference between commercial and residential?
I think it's from the same person, right?
Yeah.
In terms of the mortgage prior to 2014, there's no mortgage market in Vietnam. If you want to borrow money for 10, 20 years, there's no existence. But after 2014, the loan right now can extend it to 30 years of the mortgage. And the spread, normally the first few years is financed by the developer. So it could be really cheap, like 6 to 8%, sometimes free, because it's covered by the developer. But normally it over the deposit rate plus 4%, 3.5 to 4%. So right now, if you do it, will be around 9.5 to 10% right now.
All right, Chang, you're on again. The question I'm going to put to you has actually been asked in different ways by a bunch of other people, right? So this will cover a lot of members of the audience. Radial development in Bangkok and Jakarta has caused bad traffic congestion. Is there a balance between developers' plans and the plans of mass transit? Do the developers have to contribute to traffic mitigation and other infrastructure development? What is the progress of the first metro lines in Hanoi and Ho Chi Minh City? Any signs of acceleration in timeline? And generally, what is the public sector record on infrastructure completion? So that's multiple questions in one. If you need to be reminded as you go through the answers, just ask.
Bill, this is a big job. Okay. Well, I mean, but the question is interesting, and also, and I mean it, and I think that any of us here have that concern in the questions. So I thank you, first of all, for who make that questions. Well, that's also personally my concern. And we see, well, I think that we hope the government in Vietnam right now is working really hard to not letting that happen. And we need to see more. And particular to that is that they have been working really hard to try to develop and also relocate somehow the population to the outskirts of the city, so that remove the pressures in the city centers. So we hope that we don't face the situation like Jakarta or Bangkok, like it took like 4 hours from the main city to the airport. And second of all, we also see what the government here they are working on is that they also relocate the airport, which is just quite similar to China, like Shanghai, and they have the airport in Busi side and Pudong side, and this happened. And honestly, In terms of what the presentation in Reagan Capital Show is quite interesting, where we comparison of the the amount of capital invested in the public infrastructure. Of course, China is massive. It's like futuristic infrastructure of the world. Vietnam, in terms of, if we put it into the perspective, we see that Vietnam invests in huge in infrastructure, and we only behind Indonesia in terms of infrastructure investment. And when we say, okay, in Southeast Asia, Vietnam spend the second largest GDP into infrastructure. So I cannot say whether we go into the traffic congestion for Ho Chi Minh City and Hanoi like Bangkok, which is just we are now facing already. I cannot say whether it won't be the case, but I really think that is somehow I hope that it won't happen because of that first. And second of all, for back to the infrastructure investment, where we have the figures showing that Indonesia that invested the largest GDP into infrastructure, but also if we look at the breakdown to a little bit small figures, Indonesia that formation by many islands, so for sure infrastructure cost will be much higher than Vietnam. It doesn't mean that we invest less. It doesn't mean that we sort of not doing a good job. So that I put it that way. So the government, I felt, is totally aware of the situation of the macroeconomic growth. The only thing that what I concern is that the completion of public transportation or infrastructure, and everybody concerned when the metro going to be completed. I think that the first line going to commit in operation quite soon in the next 2 years. And also the ring road is quite key that for us to push the development to the outskirts. And also Vietnam react quite quickly in terms of formations, satellite city planning. So I think that that will remove the population in the core city, that for sure. So that all I can say for now, if I give you an honest answer. And the second honest part that in my personal view, I still have that concern honestly, because all the infrastructure in the old cities, Ho Chi Minh and Hanoi has been built and developed since 1975 when Vietnam economy totally different.
Right.
And there is a very limitation for us, the government, to do improvement on that. So perhaps within the core city, we won't see that happen. But because of so if we look at in another perspective that for the efficiencies of business travel in the future and the completion of the airport in the phase 1, we hope that won't be like Bangkok or Jakarta.
Okay, thanks for that. I think Vietnam got a bad reputation for being slow on infrastructure, but an undeserved image because it slowed things down for a couple years during the anti-corruption drives, right? Before that, they'd been spending a lot of money on infrastructure, and now it looks like they want to get back to where they were before, just return to form. So Dr. T, there's a question about this subject. It says one barrier to real estate expansion recently has been the authorities wanting to stamp out corruption. Has this availability of land zoning permission risk gone away? I think it has improved in 2019 and 2020, but has it gone? Is the overall process now faster, more transparent, or still a bottleneck?
In the short answer, is still a bottleneck. Given COVID happening, the focus of government right now is COVID content, not much on the free up for the paperwork for real estate. But given the new government right now, given the new prime minister, which I think is very decisive and willing to take action, I think I would say the faster speed will come back in late June 21 or June 22.
The precedent was for them being quite aggressive on infrastructure at one point. So
that's correct.
Say is pretty sensible. Question for Taw. This is a very granular question. Are there other conurbations apart from Saigon and Hanoi, that are seeing the emergence of new satellite cities? Which areas will benefit the most from the upcoming infrastructure property cycle, northern, southern, or central?
I think southern area would benefit the most. The reason is in the last 3 or 5 years, infrastructure in general has been disbursed and invested mostly in the north. Is in a disproportionate allocation, right? So in the north, all the highways, ring road has been basically finished. So the upside would come from the south and the central, and especially in the south, because in the last 2 or 3 years, there are very few infrastructure projects being finished. And going forward with what the government has promised and has done, I think southern infrastructure will improve a lot. The second beneficiary is, of course, the central area, because that is where hospitality in Vietnam will prosper. And that's one of the key focus of the government right now. So I think the south and the central area will benefit the most from this investment cycle.
Okay, and of course, Minh concentrated exclusively on Saigon and Hanoi that are developing into mega cities, by which we mean, the original city and all the satellites, right? But are there other cities which are going through the same process now? What about Can Tho, Da Nang, and others? Or is this strictly limited to Hanoi and Saigon?
Fortunately, it will not be strictly for Hanoi and Saigon only. In many areas, we see a lot of big public being invested and money has been flowing everywhere. For example, in the south, we all heard about some key infrastructure projects like the north-south expressway, right? The government is pushing a lot of progress in the south, and going forward, it will continue to be the case. And not just road and bridges, there will be new airports in Dong Nai, in Phan Thiết, and in other areas. So the whole picture is the government is trying to develop a broad-based infrastructure plan. And I believe that many cities will benefit from this, not just Hanoi.
Okay, well, we're running up on time here. It's currently 5:10. If the audience has stomach for a few more questions, we'll run through them real quick. This is one for Dr. T, I think. What type of average medium-term valuation level do you think would be appropriate for the Vietnamese equity market? So this is a stock market question, not property.
This is a good question, actually. If you look at all the emerging market in the region, they trade around 16 to 20 times price earning. So the question is, can Vietnam trade up to 16 to 20 times price earning? I think the answer is not yet. The reason is because Vietnam level of participation from retail investors in Vietnam is not high enough compared to, for example, Thailand or China, or all the countries like Malaysia and Indo. However, if you give Vietnam another 5 years, I think the level of participation from retail could be way higher, could be like 5 to 7 or 8% of the total population. Then yes, the convergence will happen, and Vietnam should be around 16 times price earning. But that's also conditional on the interest rate level in Vietnam. So if the interest rate level in Vietnam coming down, then it can trade up to like 16 to 18 times. Otherwise, 16 times will be the average medium term for valuation for Vietnam. Thank you.
That brings us, I think, to the end of our questions. So I'm going to say thank you to the audience for joining us. Thank you to our analysts, and a special thank you to Chang for taking time out from Jones Lang LaSalle to be with us today. And we look forward to the next webinar with our listeners very soon. Thanks to all.
Thank you very much.
Bye.
Thank you.
Bye.
Bye.
Bye.